Want to learn Excel through a real world project? Let's reverse engineer this one. Hi everyone, my name is Mahesh Kadravan. I am a spreadsheet coach and I am working professionals to learn Excel to practical projects instead of memorizing the formulas. Because in my experience, people don't struggle with formulas. They struggle with understanding why formulas is being used and how different formulas can work together to solve the problem. And that's exactly what we are going to do today. This workbook contains 5 different calculators. At first glance, this looks like a simple spreadsheet, but hidden behind these numbers are very useful Excel concepts. We learn how compound growth is calculated, how inflation calculations are built, and how purchasing power can be modeled. That's how Excel's financial functions can be used for goal planning. Now, before we begin, I want to watch this video differently. Okay, don't focus on the financial calculations, focus on the spreadsheet thinking. For every calculator, ask yourself what are the inputs, what calculation the Excel performing, why was that formula chosen, and what was Excel concept am I learning? Because once you understand the logic behind the formula, you can use the same thinking to build hundred of spreadsheets solutions. So with that said, let's start with the whole video. So I will be sharing my screen. Now here, if you see, there are 5 tables are there. One is your value of lump sum. So imagine now if you are in the personal finance area, okay? Now imagine if you want to invest in any instrument. Now this is not related to any financial product, be it mutual fund, stock market, that's not different. Okay, I'm not putting this in the product wise. I'm just putting, like for example, if you invest 1 rupee, what will happen? So in the 10-year, different tenures like 5 years, 10 years, 15 years, 20 years, and 8%, 10%, 12%. 15% return. So that means if you invest 1 rupee as a lump sum in 2 years for 8% interest, how much you will be getting? 1.117 rupees. That means 1 rupee 0.17 paise. Okay. Now imagine a different scenario wherein you're putting monthly SIP of 1 rupee. Okay. Tenure of 2 months, sorry, 2 years, that is 24 months and 8%. How much you will be getting? 25 rupees 0.93. That's around approximately 26 rupees you will be getting. Now here, please note, I have not used any inflation, this thing. I have just used the interest rate of 8%. Okay. Now, if you see the third table, this is all about the inflation. So like how inflation can lead to jump in the expenses. So I wanted to show you what inflation can, because normally what happens in the personal finance, if you see, we don't take inflation into account, or whenever we go and sit with the advisor, we don't think in this kind of numbers, how the inflation is affected, on we don't ask the question to the advisor as well. Okay, so for example, if your monthly expense is 1 rupee and tenure is for 5 years, so every 5 years your monthly expense is 1 rupee. So what will happen? So interest rate will be 3%, and the rate of the inflation, that means 1 rupee 116. That means if you're putting 1 rupee as an expense, with 0.16 paise is your inflation, which is impacting your your savings account. So how is inflation reducing the purchasing power? So if you see, you put 1 rupee, but over the tenure of 5 years with a inflation rate of 3%, you imagine your one rate, the power of 1 rupee has reduced to 0.86 paise, which means that whatever things you were buying at 1 rupee at that point of time, after 5 years, it has gone down. Okay, so this is very important thing. And the last table, but not the least, is your target this thing. Okay, target corpus. So what is the inflation needed every month? Inflation investment needed every month to accumulate your target corpus. So if you see this target corpus, I have taken as 1 crore, and for 10 years I have taken interest rate of 8%. That is around 54,661. Now, why I'm showing this all four levels is use of the Excel functions of financial related domain. Also, for you also to track the numbers, which can enable you to talk in a proper way to your financial advisor. Because rather than speaking about and asking the questions about what kind of returns I am taking, this is very, very good. Okay. So let's start at one table and then we can go back. Now you see here what we have done. So imagine you are putting this particular table and then we are going to the table number 1. Okay. Now If you see the table number one, it's very different kind of formulas, but let's break it down because if you see here, C what all one is there, one plus one, and B raised to seven. Now, what are the parameters we are taking for the calculation? So one is tenure. We have taken the C1, that is number of rupees, whatever amount you are putting, into 1 plus 0.8. Now, why it's 0.8? I will tell you the reason. And then raised to dollar B7. So B7 is what your tenure 2 years. Okay. So what are the three parameters? 1 rupee, your 2 years, and 8%. This three we have taken and that value has come. But what exactly this is all about and how we are going to do this is more important. Okay, so let's do that. Now, the purpose of one table, this thing to answer a simple question. If I invest a lump sum amount today, how much I can get or how much it can become in the future. This is a simple thing, like nothing else have to do that. Okay, now let's understand why this argument is there and how this is going to be helping you in the scenarios. Okay, so let's break it down. Now, when we talk about, first let's break it on this one. Okay, this one. 1 plus 0.08. Now, this is very important thing. See, why I am adding 1? It's a very good question you need to ask. See, because simple, you can do 8% means what? 8 divided by 100, which means 0.08. Okay, 0.08. But why I am adding 1? See, because the Excel stores 8% as 0.08, right? That's okay. But if I only use 0.08, I'm calculating only the growth percent. But what about the compounding? This is where your mind should go. Okay. So, but I want the original amount plus the growth amount. So, which means that what is the original amount is the 1 rupee, then plus 0.08. Okay, which means 1.08, which means 100% of the original amount plus 8% of growth. That is what the compounding growth is, right? Right? You're understanding the thing? Okay. Now let's move to the next thing. Now, if you see, this is important thing. Again, the raise to operator. This is very important. See, whenever we speak of raising, this is called as a power operator. Okay, one of the important operators in Excel, because when Excel sees that 1.08 raised to 10 or the B7 is 2. Okay, so 2 years, which means that it has to multiply by 1.08 by. So that means the compounding is created. But how it is created? So instead of writing 1.08 into 1.08 into 1.08 into, he is writing 1.08 in the single operator. That is called as this thing. Okay. Now let's look at this dollar sign. C1, you know what is C1 is tenure. That is, sorry, the amount which you are invested. That is the thing. But what is that dollar sign? Which is very important. We need to know. So dollar signs are absolute references. So whenever I drag that formula down, I don't want Excel to move away from the original investment amount. So I lock that cell using dollar signs and think of the dollar sign as an anchor because they keep the formula connected to the same cell. And that is what we needed because here we change the amount. This tracker is actually reusable. So if I put 100 rupees, see, it will get it and it will give you the answer. This is how it is done. And I will keep it 100 rupees so that it will, now you make a little bit this thing. Okay. But this is how the scenario is being done. Okay. Now, from this formula, what we learned actually, if you see, okay, what we learned four Excel concepts. There's one is arithmetic operators, then the brackets, then the power operators, then the absolute preference. And this is exactly why more project-based learning is so powerful. That's why I've taken this personal finance so that you will able to understand. Now, let's look at the second. Now look at the second table. See. Now here the second table is very interesting actually, if you see, because this is the first formula where we are introduced the nested brackets. So here if you see nest brackets are there, see two brackets we have opened. The earlier formula we didn't use that. That is more important. Okay, now let's understand. We will break it down. The what is happening? The first one is the 0.08. Okay, the 8% is been divided into monthly. Why? This is annual. Say, for example, if you're putting in a particular monthly investment, SIP like mutual fund. So what happens? The interest is not given to you in month daily basis, right? Actually, you're putting investment as a monthly, but the interest is calculated as an annual rate. But you need to divide it into monthly so that since you're investing in monthly, you need to get the monthly. That is why 8% has been divided by 12, which means 0.08 divided by 12. Now, when we talk about the monthly growth factor, what is the growth factor? Is this 1 plus 0.01. So 1 plus 0.08 divided by 12. Now again we are raised it to the 12 months. Raise it to the L7. So L7 is what? L7 is 21. So this will again change. Okay. Tomorrow it might be 36, might be 3 years, then 4 years, then 5 years, then 6 years. It might be the reason. Then we are subtracted by 1. So we subtract by 1, then divide by monthly rate, then monthly multiply by SIPM. So notice how these formulas are built layer by layer. Okay. Simple thing, nothing hardcore wrote. What is the formula we have used in the first table, the same table we have used. So we build a logical block at a one at a time. And that is a huge spreadsheet lesson which we are learning from this table number 2. Because this is how the whole block is created. But if you're not able to understand the simple things, then that will make a good problem. Okay, now let's jump into the third table. Do you think this formula did we used earlier? I explained it at table number 1 because one of the biggest lessons in Excel is that the same formula can solve different business problems. And this is exactly what I'm telling to my students as well. Don't use all the formulas in Excel. That's not needed. See, Microsoft has provided 500 different formulas. Doesn't mean that you have to use every formula for every different reason. You have to think from the logical perspective. Can I use this formula with respect to this? That way, you can understand more perspective and more less use of that and more logical. So you don't stress yourself remembering all the formula. Yes, right now we have ChatGPT and AI, but that will not serve the purpose what you want. Okay, so this is very important thing which you need to understand. So the table, this thing, if you see the same thing, nothing we have done differently. So there's nothing more to explain to you. But if you see the difference, whatever they explained the table number 1, the same thing we have done. Okay. Now we go to the table number 4. Okay. Table number 4 is very important because if you see here, table number 4, you have M14. There is M14 is what? M14 is your savings account, right? 1 plus 0.03. Okay, that is your inflation rate and raised to L20, that is your tenure 5 years. Okay, now we have introduced multiplication versus division. That means in table 3, if you see, we have multiplied. Okay, but here what we have done, we have divided. That is exactly the simple thing, nothing else we have done. This is the power of simple formulas of Excel, the logical brain we should work. Okay, but why we have done that? Table tree increment. What means what? If you put today monthly expenses 1 rupee, and when you put the addition of 3%, which means that you are putting additional of 16 paise. That means 1 rupee 16 paise. But here it is actually eating away. What we are showing, inflation is how eating away your purchasing power or savings account. This is how it has been done. So the table 4 brings the value backward. Table 3 moves forward. This concept appears everywhere in the financial models. Okay, and this is the great special lesson if you can learn. It's very good. Nothing simple, nothing more simple. I can't make it. This is how we can do it. Okay. Now we come to the last and final table. Is it a target corpus of 1 lakh? But how much investment we need to make it in 10 years with 8% interest? So what will happen? 54, 6, 1, 10 years, right? Investment needed person, then 15 years, this one. So this is the highlight because here you are seeing a very different function of finance that is called the PMT. Now, PMT stands for payment. Okay. And what does arguments? Let's see the argument. So first argument is what? 0.08 divided by 12, which means what? They are divided the 8%, okay, divided by 12 that they have done. The second argument is what? B33. B33 is what? This one. Okay. B33 into the 10%, the 10 years into divided by 12%. Why? Because we have to calculate in the monthly style because we need monthly, invest every month. That's the thing. The third thing is we are starting from the zero. So this is how the future goal is there. So this is how the formula is calculated. Now, if you see the whole concept of this particular file, they are pre-built formulas created by Microsoft. But instead of writing in the long formulas ourselves, we always use a function that is already exist in the mathematics that is called the PFT. This is exactly how this is happening. So I have shared the problem, I've shared the formula, I've broken down the formulas into parts. I explained the things, the nitty-gritties of the formulas. I explained the Excel concept and the financial concept and the real life application also. So with this video, you learn Excel, but not watching merely learning about a personal finance, but you learn about. With that, I end this video. Let me know your comments, how this file looks good for you. And I will surely come back with such important things which can help you a lot. Okay. Thank you and see you for the next video.